Depends. It's very unlikely they would just, you mean franking credit refunds or franking credits altogether? Because the issue last year was, or this year, sorry, was about franking credit refunds being scrapped. So I was not planning to change my strategy at all if franking credit refunds were scrapped, because even if those refunds weren't coming in, you're still getting a 4% dividend yield, is still tax effective, so you still have the tax credit, it just won't be refunded to you. So it's still, that 4% income is still tax protected in a way. But if franking credits were scrapped altogether, I think there would be either something else to compensate for that. So maybe lower company tax rates. So that's been kind of thrown around as an idea. And if that happens, company tax rates would go down, company earnings would go up, so the market would go up, and company dividends would go up. So there would be some sort of compensating mechanism at play. They wouldn't just take something away so drastically as franking credits entirely and not have some sort of compensation. But yeah.
If you just, say, for example, take a look at the US market, they don't have franking credits, and so companies change how they return to shareholders. Over there, they'll return more in terms of capital gains, which means that versus here, where we have, you've got, I think you'll know the averages better than me, but say a 1.5% dividend yield on average in the US market versus here it's sitting at 4%. And the reason for that is because we have this franking credit system in place which incentivises companies to be able to pay back to investors the dividend form of income. And if you look at two markets, the total return is pretty similar over time between AU versus US, etc.
And you'd probably find that if something like that happened, the market would fall quite a lot if there was no sort of adjustments made elsewhere. So if that happened, guess what happens? You're now not buying at a 4% dividend, maybe you're buying at a 5 or 6% dividend. So it kind of changes the maths on that as well. So that's something else to consider.
So what Dave's mentioning there is the efficient market hypothesis, and that is just basically that all of the factors are priced into the market. So currently this dividend franking credit is priced into the market by all of the players in the market, all of the investors, all of the professional managed fund investors. And so if the franking credit was immediately removed, then all of those investors would compare the returns they can get on the Australian market with the returns they can get on other assets like property, international share markets, and automatically they'll take money out of the Australian market because they're now losing that 1.7%, and the market will balance itself out. So it's it really is a red herring. It actually doesn't matter.
So it would move to a lower valuation and a higher yield and future higher returns from that lower valuation. So it's hard to say what would happen, but if it happened completely, as you're saying, like franking credit scrapped, I would consider looking at other options, but it would depend what the market reaction to that was and how drastic it was, and if there was any sort of other mechanisms that would change to compensate. So it's kind of a complex topic, but I think it's extremely unlikely considering they couldn't even get the refunds scrapped. And that probably won't come up at the next election, so it's probably another 8 years before it's even considered. So I think we don't have to think about it for too long.
Not entirely your question, but I think if drastic changes do happen, the people who are informed and who know things and who look at things and can have a little bit of a buffer, you'll have more opportunities as well, and you'll be able to pivot and you'll be able to change your strategy if you need to, if changes happen. So it's just about being prepared and having a look at what the options are for you.
But if that sort of thing was to worry you, then definitely have more money invested in overseas share markets. I mean, there's no use having your money invested here just because you think it's a good idea, but then in the back of your mind, you're worried about something happening, so you kind of have to make that decision as well.